Hello, I'm Richard Weinberger, the CEO of the Association of Accredited Small Business Consultants. I want to talk to you today on this video about statement of cash flows. Now, the statement of cash flows is an important financial statement along with the income statement and the balance sheet, but not every small business uses a statement of cash flow. Not everybody is actually really familiar with it. So let's talk about it. Sometimes it's actually called the where got, where gone statement. You might say, where got, where gone? Well, that's what the statement of cash flow actually is, and that is, where did we get the money and where did it go? Where got, where gone? Sort of a nickname. It's really the sources and uses of cash in a business. And why is this important? Well, it's critical in forecasting the future cash needs of a small business. Again, cash is king in a small business, as I've said many times before. So it's critical in knowing where did the money come from and where did the money go? And that helps us then predict for the future. Then the income statement, it is important to know, is not the same thing as a statement of cash flow. And that's what I want to go over with you today, what some of those differences are. Net profit is not the same thing as cash flow, because a business can be profitable and have no cash, especially if it is selling merchandise or services on credit, and we have a lot of accounts receivable, but yet we still have to pay our bills on time. The books can show that we're very profitable and we have no cash. If we have no cash, though, to pay our bills, it doesn't matter how profitable we are, we're going to run into trouble as a small business. Now, these are the differences between the statement of cash flow and the income statement. The statement of cash flow details cash, but the income statement does not, especially if it's on the accrual basis of accounting. And what is the accrual basis of accounting? Well, we recognize the income when it is earned, not when it is received, and we recognize expenses when they are incurred, not when they are paid. So an income statement then is not going to be the same thing as a cash flow statement, and that's really, really important to understand the differences. Also, net profit. The statement of cash flow only reflects cash from sales, money that we've actually received from sales, where the income statement reflects cash and credit sales, especially if on the accrual basis of accounting. Now, if the small business happens to be on the cash basis of accounting, then that is going to equate more to the statement of cash flow than a regular income statement. And these are some of the things that we're going over today, that if you join the association and you are looking at the entire 40 video lecture series and our training manual, all of these things are explained in quite a bit of detail. Let's also talk about some other differences between the statement of cash flow and the income statement. The statement of cash flow only reflects expenses when they're actually paid, where gone, where we actually paid the money, but the income statement then reflects the expenses when incurred, again, if the small business is on the accrual basis of accounting, which is GAAP, generally accepted accounting principles. Statement of cash flow does not reflect non-cash items such as depreciation or amortization. The income statement on the accrual basis of accounting will reflect non-cash items. So again, what we're talking about on the statement of cash flow, we are only interested in the amount of cash, where we're getting the cash in and where the cash is going. And again, that's going to help us predict what the cash is going to be in the future. Statement of cash flow answers questions such as, how is a company obtaining cash to operate? This is really important, and we're going to go over again some more examples here on the next flip chart. Is the money coming from operating activities? Is it coming from loans? Is it coming from investors? That's really important to know, because if it's coming from operations, that's good. If it's coming from other sources, those sources might dry up after a while. Where exactly is the company spending its cash? Again, is it on regular operating expenses, or could the company be spending cash again to repay loans, make investments themselves in other type of entities, purchasing equipment? These are important items to know. And what caused changes in the cash balance from the beginning of the period to the end of the period? In other words, what we want to look at is what happened what was the balance at the beginning, what was the balance at the end of the period, and what transpired in between. So the statement of cash flow is actually separated into three distinct activities: operating activities, investing activities, and financing activities. What are operating activities? Transactions determining the regular net profit in a business. Just day-to-day, open our doors, cash from sales, cash payments to suppliers. Investing activities, acquisition and disposition of long-term assets, sometimes called long-lived assets, fixed assets, and also any type of investment assets. And then also the third section is from financing activities, external financing transactions. Company is borrowing money, investment from owners, loans repaid, or money distributed to owners. So the statement of cash flow that you can see with these three distinct activities is different than the income statement, but the statement of cash flow is really, really important. If your client is not using a statement of cash flow, suggest the importance of the statement of cash flow. Again, I hope you enjoyed this video. Come visit our website at aasbc.com. Consider joining the association and becoming an accredited small business consultant. Thanks for watching.